makes the silver or gold market so different than something else that trades on the quote-unquote free market? And I'd like you to break that down a little bit for us. Where is the manipulation between the buyers and sellers of the futures market?
Well, Ken, first of all, thank you for the kind words. And though we've had a tough couple of years, just like everybody else in the precious metals, we've had a good 2017 as we've been trying to fly kind of contrarian to the general point of view, which was after the election of Trump that interest rates were going to go up, there was going to be all this infrastructure spending, and the dollar was going to get stronger, and thus the metals were going to go down. And we thought that was an incorrect way to look at it. In fact, gold has a history of rising even during rising interest rate structures, environments. And so anyway, though, this year so far is playing out pretty much as we thought it would, with the metals going up, not down. Now, to your question about the silver market in particular, the main thing folks need to understand is it's a very small market. You can buy all of the silver in the world for like $20 billion or something like that. It's a very small market, and it's easily manipulated by a couple of banks that have concentrated, extreme, manipulative short positions on the COMEX. This shows up in the regularly reported data by the CFTC, whether it's the Commitment of Traders report or whether it's the bank participation report. And anybody that follows these markets on any regular basis knows what happens. In a period of rising price, speculators, I guess largely grouped as, trading funds and hedge funds and individuals and people like that, come in and they take long positions in the COMEX silver market, looking for silver exposure, basically gambling the price is going to go higher. Taking the other side of that trade are these banks, which are in charge of, I guess, making markets, providing liquidity, specifically JP Morgan, but also a handful of others like Citi and Scotiabank. Now, what's unfair about it is that there's never a fixed supply of these contracts, okay? If you trade in the stock market, for example, and you're buying shares of, you name it, any individual equity, on any given day basis or weekly basis, even any longer term time frame than that, the amount of shares that are generally outstanding and readily available to trade is constant. Now, companies can always file secondary offerings and dilute the amount of shares they have outstanding on a long-term basis. But on a daily basis, the amount of shares that are there to be bought or sold are pretty constant, like I said. And so if suddenly there's a big rush of demand for the shares, let's say, whatever company has some great earnings report, and now all of a sudden there's more buyers than sellers, there's a constant supply of those shares, then price has to move up to get to the point where existing holders of those shares will sell to these folks that demand the shares, right? You've got to find this new price equilibrium. Well, that's not the way it works on the futures market or in COMEX silver, because instead, when there is demand for the derivative contract, these banks like JP Morgan, just simply create more. And that's what we've seen, especially over the last week. The banks have added more than 15% to the total supply of these COMEX contracts. We've gone from 190,000 contracts on the exchange to up over 220,000. Mm-hmm. And these contracts are just simply created from thin air. It's not as if the world's silver miners suddenly lined up to hedge 20% of the global silver production in the last week. That's foolish to even think that.
Craig, let me jump in right there because I want to ask you about that. So when it comes to the banks and what they're doing, is there an equal and an opposite risk that they're taking by doing that?
Yes, and that's again another basic argument people put out there to say, well, there's just as many hedged longs, there's a long for every short. Well, yeah, that's right, but it's not a fair competition. These banks have they're backstopped ultimately by the Fed. They have unlimited deep pockets versus some individual trader or a small hedge fund or something that has margin calls that they have to meet if it moves against them. Mm-hmm. And so basically what a bank like JP Morgan does is they just figure they'll just wait you out. Wow. They'll just continue to sell new contracts to the speculators until at some point the buying interest runs out, maybe for whatever reason sentiment changes or there's failure at some key technical point on the chart. And then all of a sudden everybody heads to the exits at once. It gets exacerbated by margin calls as the late buyers, all of a sudden are underwater in their positions, and JP Morgan just waits them out, and as price falls, the speculators start to sell. JP Morgan buys back those contracts that they shorted.
Yeah.
And it's good work if you can get it. If you have the unlimited, almost infinite ability to print paper silver to sell to those specs, heck, you can make a heck of a lot of money managing your trading desk that way, and that's what JP Morgan does.
So let's talk about the risk a little more for the banks. Is the bank's risk, and I ask you this, for you to explain it, because you do a beautiful job of it. The bank's risk is us as investors. That's our explosive upside. That's what we're all waiting for, at least.
Right. The bank's risk is they get overrun and swamped. And this is where some interesting history can be sought out by anybody that's willing to look. I was there witnessing this in 2011, and then probably most people listening to us remember these days. Back from late 2010 into the spring of 2011, silver had this explosive rise. First, it moved, rather gradually from 20 to 25 up to 28, and then there was a period of 90 days where it went from 28 to 48. And specifically in April of 2011, that last 25% or so, where it went from under 40 to nearly 50, a lot of that gets classified these days by people that don't know any better by saying, oh, that was some big speculative bubble, as if every shoeshine boy and taxi driver was out buying silver. That's not the case at all. Anybody can go back and look. It's all on the internet for you on the CFTC's website. That last $10 in silver was a commercial short squeeze, primarily of JP Morgan. And they were getting squeezed hard as price was rising. All that they could do was cover their shorts into a rising price, and that's what was going on. What happened after that was a series of margin hikes from the CME and the COMEX to try to flush speculator interest back out. We all know what happened. I don't need to relive that. The moral of the story was JP Morgan was caught with their pants down, short maybe 20, 30,000 COMEX contracts, but with no silver behind it. What happened next then in May and in June of 2011 was JP Morgan was suddenly and very quickly approved to open their own COMEX vault. So back in 2011, they didn't have a COMEX vault. Oh, there was a Scotia vault, there was an HSBC vault, there were 5 of them. There wasn't a JP Morgan vault. They had no silver backing up that massive short position, and they almost got a true religious experience of a commercial failure. So what was happened right away after that is they were approved for a vault. They've been accumulating silver ever since. You can look at the CFTC's delivery or the CME's delivery reports for the last 2 years and see that the house account of JP Morgan, their own proprietary account, has taken delivery of more than 50 million ounces of silver on the COMEX without issuing back out any. The eligible vault now in JP Morgan's vault of silver at the COMEX is now north of 90 million ounces. And so what JP Morgan's plan, I think logically you can deduce this is to continually short. They get away with saying they're hedging that 90 million ounces by maintaining an 18,000 contract short position on the COMEX, a dominating manipulative position. But if there's ever a run again, if it ever gets away from them, if there's ever this craziness happens and we go running up through 30 and 40 again, this time JP Morgan can close out those short positions just by delivering the physical silver that they've accumulated here at the bottom. And they're not at risk of, some multi-billion dollar loss anymore. See how that works?
Well, I want to talk about gold and silver and its stealth move higher here off the December lows. Gold has moved up north of 1250, and silver's at 1830 at the moment. Silver was all the way down for a brief period of time in the $15 range. And is this Trump optimism fading? All the news and all the turmoil that we're seeing in politics and people going back to the safe havens, as the stock market kind of just peters around and kind of hitting the ceiling and trending downwards. Are people losing faith in the economy that they were hopeful of just continuing onward and potentially getting fixed by a Trump administration?
Yeah, no, that's exactly right, Ken. And that's what when I mentioned earlier that we've been having a pretty good year as a contrarian, and that's what you're driving at. And that as soon as Trump was elected, remember Trump was supposed to be bad for the stock market. Remember that whole thing in the run-up to the election? And then immediately election night, all of a sudden Trump was great for the stock market. And in that last I don't know, 6 or 7 weeks of 2016, we were told that, oh, this was going to be easy. The dollar was going to soar, king dollar. The bond market bubble was going to burst after 30 years or whatever it's been, because rates were going to spike higher. And all of this was going to be, really good for the dollar, really good for the stock market, all this infrastructure spending and tax cuts and all this, as if it was just a fait accompli, a done deal. And we said, on my side, no, I don't know. I'm not buying that. I don't think it's going to be that easy. And that's how it's played out so far in the first quarter. And I think as we go through the year, more and more, rational people are going to see the reality of this and go, yeah, maybe it's not going to work out that way. Provide, more and more opportunities for the metals to go higher. At present, we are in a really interesting spot in that both metals are pressing into very interesting positions technically. Gold is pressing up against 1260. The significance of that level is that's where the 200-day moving average is found. And if you draw a trend line from the highs of last July and extend it all the way down, through some of the highs last fall, that point is at about a 1260 right now as well. So if we could somehow, maybe using Friday's employment report as a catalyst or something, maybe next week, whatever, if we could somehow surge through 1260 here and maintain a toehold, that'd be a really, really good sign, and we could make a move to 1300 pretty quickly over the course of this month. Silver is also at a very interesting crossroads in that a lot of folks have been watching longer-term technical features in silver. In fact, specifically, the 50-week moving average, which is like a 200-day, crossing up and through a 200-week moving average, which is like a 1,000-day, okay? Those two just bullishly crossed yesterday, as a matter of fact, and price has surged above both, which from any technical sense is extremely bullish. I mean, looks great. On the flip side of that, though, we have some of our traditional, I don't want to call it fundamental factors, some traditional COMEX factors like the Commitment of Traders report, which show a very bearish structure from how many speculators are long and how heavily the banks are short. So you've got a very bullish technical picture, but a very bearish, I guess, internal picture in terms of the Commitment of Traders structure in silver. And so we'll just have to see where we go from here. It's very possible that gold could continue to catch a bid, could slash through 1260 in the weeks ahead and drag silver higher regardless of that Commitment of Traders structure. But it's one of those things where we're at a very interesting juncture. We're beginning a new quarter. We've got the latest employment report coming up here on Friday. It's a good time for people to kind of stay on their toes and be wary that things could go either way in the short term.
Sure. And you alluded to this earlier, rate hike to rate hike, we're seeing gold perform very well. From December 2015, it's doing very well, but with the economy seemingly petering out, or maybe the optimism petering out, do you think we're going to continue to get these rate hikes? And is that going to potentially keep gold down? I mean, without these rate hikes, it seems like that's what we need here, even though conventionally that's bad for gold. That's stronger dollar, when you tighten the monetary policy. But any thoughts on that?
Yeah, no, that's a very interesting thing to be pondering at this time, because you can't doubt the chart, right? I mean, we put in a low in December of 2015 at the first rate hike in 8 years. We put in a higher low last December. We put in another higher low just 3 weeks ago. So undoubtedly, that trend is our friend. But what's causing it? I mean, is the market enjoying the higher interest rates, just like we saw back from 2003 to 2007, where there were 17 Fed fund rate hikes and gold went from 300 to 1,000? Or is the market anticipating the Fed just strangling whatever signs of life, are there, and a resumption of QE and everything else by later this year? I'm not sure what the correct answer is there. Perhaps our clue should be taken instead not from the dollar, Ken, but from the bond market. Because again, everybody and their brother was talking about, oh yeah, here comes the busting of the bond bubble and all this jazz. Well, the Fed now has raised twice in the last 90 days. But the long end of the curve is actually down. Rates have fallen. In fact, if we just look at the action over the last 3 weeks since that second rate hike, the 10-year note's fallen from 265 to 235. The long bond's fallen from 3.20 to under 3%. So the Fed is only flattening the yield curve, which in any traditional sense is a precursor of recession. Maybe, again, what gold is anticipating is not so much higher interest rates, in a return to 2003 or 2007. Maybe gold's anticipating a weaker dollar and more QE.
Interesting.
Instead, as the Fed crushes the economy with, whatever life is there, inverts the yield curve, you get more and more buying of bonds, lower and lower interest rates, and, a return to where we were in 2010.
Right.
I don't know, Ken. It's an interesting time to be alive, my friend. I know that. And all I know is I'm not falling for just the general claptrap of, oh, yeah, well, we're in wave X of subwave C of microwave D, and that means that we're going to 826.50.
Right.
I don't buy that one bit. These markets are grossly manipulated by the banks, and so I think all the wave and cycle stuff you can throw out the window because the charts are painted by the banks through the issuance of these naked short contracts. I instead see this bigger picture of where the economy might be headed versus where everybody might be thinking it's headed, and that's what may play out as we go through the remainder of this year. Without, unlike 2016 where the highs came in during the summer, we may see the highs of this year for price in the fourth quarter and then extend those gains into next year.
Sure. Craig, then in hindsight, I'm curious what your thoughts are as to what took gold from 1900 down to 1050 with them cutting interest rates. And I know maybe that's not the direct correlation, but was it manipulation? Was it the anticipation of a stronger dollar in that environment? In just comparing the two, comparing what we're seeing now to an environment of slashing interest rates and the expectation for the reaction gold had, if that makes sense.
Okay, Ken. Now we're really going to go off the deep end here. You ready?
All right, let's do it.
This is, we could do a whole call on this. And people are going to listen to this and think, that guy's, he's just making excuses or he's nuts or whatever. But I firmly, and I mean, believe this 100% with all my heart. The markets, as you know them, broke, died. They've been zombies, whatever, ever since 2008. And beginning in 2008, 2009, the central banks figured out that they could get the markets to, and I'm talking all markets, to paint this image of recovery and economic, happiness and all this kind of stuff, the wealth effect that Bernanke always talked about. You could make the markets move a certain way because everything is done now by a computer. So if you could get the computer algorithms and the HFT platforms to do all the heavy lifting for you, you don't need to manipulate the markets yourself. The Fed doesn't need to go in and buy trillions and trillions of dollars of stocks to make the stock market go up. Instead, they can just influence the high-frequency trading machines to do the work for them. And how do they influence it? By influencing the inputs that these machines look at. There's almost a one-to-one correlation over the last 5 years of the dollar-yen with the S&P 500. It's like a 98% correlation.
Wow.
And so if you want the S&P 500 to go up, then you just need to rig the yen lower versus the dollar, make the dollar-yen go up, the USD JPY. It's no more complicated than that, unfortunately. So if you take the dollar yen and you invert it and you pull up a chart of yen dollar and then you overlay a chart of gold with it, you see that the correlation there is also very close to 1-to-1. It's about 95, 0.95 correlation. So to answer your question in as brief of an answer as I can, why did gold go down from 1,800 in October of 2012 when QE3 was beginning to 1,050 to back up to where we are? Plot gold, COMEX gold, with the yen dollar, and you'll see why. The computers that trade all this stuff, the computers that demand the open interest on the COMEX and take speculative positions, the computers that trade Forex, the computer that trade S&P, they're all taking their cues from that dollar-yen relationship.
And just to clarify, that's it's amazing analysis. But to clarify, what is the cause? What would you say is the cause of that's making that relationship happen? I know that they're linked, but what's causing the move of the currencies, and is there some nefarious or market force that's causing that's bringing?
Do you mean why are the algos programmed to act off of the dollar yen, or what is moving the dollar yen?
What is causing it to move? Prior to them being linked, what is causing them to move?
Oh, the movements in the Forex are, that's one. We talk about the bond market being manipulated through QE. Forex is probably the most central bank manipulated set of markets in the world.
Sure.
It's a $5, $6, $7 trillion a day market. No one can intervene there. No one has the deep enough pockets to manipulate those markets outside of the central banks. And the Bank of Japan is known worldwide as the greatest manipulator of its own currency anywhere. And to anybody, you can follow that, and just watch the headlines, the job owning, by the current group that runs it, whether it's Shinzo Abe saying things as the prime minister, or crazy Kuroda at the head of the Bank of Japan, job owns the dollar yen one way or the other. There's a carry trade component to that has historically been there, and I think that's what's programmed into most of these algos. And like I said, after the markets died in 2008 and 2009, that's when all these correlations started to become one for one. And I think the central banks realized, if anybody listening to us if you can pull up a chart, you go to a place like barchart.com is an easy one to do it. And you can go to the futures section, pull up a chart of the Japanese yen, not the dollar yen, not the USD JPY, but the Japanese yen. That's the invert. You can plot it for 25 years, and you can see there didn't used to be a direct correlation between gold and the yen. It didn't make any sense. Why would there even be one? But once we got to 2008, all of a sudden it was there. And in particular, since 2011, 2012, it has been nonstop, day and night, week after week, almost a one-to-one correlation. You can see it with the S&P as well. And so what I think in 2017, I think anybody that thinks that there are actual markets that operate off of fundamentals, whether it's the stock market, whether it's all the way down to gold and silver. The notion that gold and silver trade off of physical supply and demand. What a cute, arcane, naive notion. No. The price is set in the paper markets by the trading of these electronic digital derivative contracts. The price fluctuates up and down because of demand for those derivative contracts. Demand is controlled mainly by changes to these Forex pairs, and from there you get price change. That's how it works. So anyway, all the way back to your original question, Ken, how is it that gold has fallen from 1,800 to 1,200 since 2012? Take a look at what the yen has done over the same time period. That'll give you your answer.
I love it. I want to ask you touch on one last topic here, and we were talking about this in the pre-interview. It's been 5 years during the bear market of death for investors, in the precious metals sector, and I think people were expecting an equal and opposite upside. And that's still yet to be said, and I fully believe that will happen. But up until now, we had 6 months of this bull market euphoria, and then since the summer of 2016, we've had that bear market sentiment re-enter the market, and I think a lot of people are scared. They're like, wait a minute, we didn't get that equal and opposite reaction, at least yet. Any comments on this?
Yeah, no doubt about it. It's all about sentiment and psychology, right, Ken? And most precious metals investors are like, those rescue dogs that, you see every once in a while. Right. Or dogs that have been rescued is what I mean by that. You see every once in a while at like the Humane Society. Right. They just got the crap kicked out of them by their previous owners for 5 years, and now they just kind of cower in a corner afraid of even the nicest people, right? Yep. It takes a while to kind of psychologically condition that stuff back out of them, and that's where most precious metals investors are. And really, even if you look at those that trade the mining shares, unless you were incredibly lucky, as I was. I was just by luck and happenstance, I bought a basket of miners in November and December of 2015. Okay. The HUI index was making, multi-year lows down at around 100, 105 back then. And just by sheer luck, I bought a bunch of shares then. I'm not discouraged. Why? Well, the HUI's at 200 and 200. It's doubled in the last 15 months.
Sure.
Hot dog, that's damn good. But that's not what that's not the experience of almost everybody else. Instead, we watched and I'm just using the shares as an example, we watched the shares rally sharply last spring. And all of a sudden, that thing went from 100 to 150, 160, and nobody was on board, right? You're like, well, this is just some kind of fake rally. I'm not getting in. Then all of a sudden, after it had already doubled, then here comes, the regular money. Oh boy, we've already doubled off the bottom. So all kinds of people started buying the shares, maybe last summer. And now all of a sudden they're all underwater. So the shares on balance on these, by the measure of these indices, have doubled in the last 15 months. But there's all kinds of people that have lost money, right? And so I think that's a great part of the reason why there's so much bearish sentiment. I mean, we need new highs really badly. We need new highs in gold and new highs in silver and new highs in the shares above where they got to last year. If that happens, sentiment will improve. There'll be a whole new rush of money into the sector, and everybody will be happy finally. But it's that, I just think it's that sentiment, up against the reality of when people actually invested that affects things. It's the same thing could be said for the metals. I mean, if all you did was buy silver in 2011 and you've got an average price of $35 an ounce, and you haven't used the last 6 years as an opportunity to just keep buying more and lowering your average cost, well, in hell's bells, you're still down 50% and pissed off. But if you recognize that, the story is every bit as sound as it ever was, and this is still an opportunity, and you've been buying silver all the way through the 20s and into the teens. Well, now silver's up year to date 13% or whatever it is. You're feeling pretty good.
Sure.
So again, it all depends on sentiment, perspective, what your cost basis is. But at this point in the metals, there's still far too many people that are buried either with losses in the last year or the last 5 or 6 years. Their sentiment is poor, and it's going to take a lot to get them back into the happy column.
Well, it's great perspective right there. Craig, if people want to learn more about TF Metals Report, let them know about what you do and what they'll find if they visit your work.
Well, the site is, I think the real value of it is in the community itself. I mean, we've got a couple thousand paying subscribers that pay for, they pay $12 a month for my analysis. But then beyond that, we've got, a couple thousand more folks that just use the site on a daily basis. And the community itself is everybody that basically we all understand that this debt-based monetary system, the Bretton Woods system and what we've done to it over the last 40 years just isn't sustainable. I mean, doesn't mean it's going to end next week. And obviously, it's lasted longer than many of us thought after 2008 and 9. But eventually, the math is just going to destroy this system. And we're all planning basically for what's coming next. And some return to some kind of sound money or asset-backed currency, something with a tether. Your investments in gold and silver are your ship in a storm. They are your facility through which you'll transition from one system to the next. We're all in that same boat. And so it's the community itself, I think, at TF Metals Report that makes it special. And I encourage everybody to check it out, tfmetalsreport.com.
Craig, I appreciate your time today. Thanks for coming on the line with me.
Ken, hey, I appreciate the opportunity. It's always fun to visit with you, and I look forward to doing it again sometime soon.